The world is watching inflation, interest rates, wars, stock markets, and currency movements. But beneath all that noise, a much bigger story may be unfolding. The United States has crossed $40 trillion in national debt. And according to this macroeconomic argument, America has backed itself into a corner where the choices are becoming increasingly limited, because eventually, there may be only one escape hatch left: the money printer. And if that happens, the biggest beneficiary could be an asset governments cannot print, politicians cannot manufacture, and central banks cannot create with a keystroke: gold. To understand why, look at the speed of America's debt expansion. Around $5 trillion was added in just over 2 years, even without a global pandemic, a formal recession, or a world war. Debt accumulation is no longer simply an emergency response. It has become part of the system. Keep the dollar strong and interest rates high, and borrowing costs rise. Bond yields can surge, stock markets can weaken, and the government's interest burden becomes even larger. Allow the dollar to weaken openly, however, and foreign holders of U.S. debt may become increasingly nervous. So when policymakers are eventually forced to choose between extreme debt pressure and currency debasement, history suggests governments often choose the path that reduces the real value of their debt, but they cannot openly announce it. No policymaker can simply say, "We are deliberately weakening the dollar." That could destroy confidence immediately. Instead, the argument is that currency debasement happens quietly, through market actions, monetary easing, and policies presented as financial stabilization. Consider Japan. Japan is one of America's largest foreign creditors, holding more than $1 trillion in U.S. treasuries. If the Japanese yen weakens severely, Japanese institutions could face increasing pressure to bring capital home rather than continue holding American debt. This is where geopolitics enters the equation. Printing trillions during calm economic conditions could look reckless, but during a major geopolitical emergency and financial crisis, the same action can be presented as a rescue mission. Conflict in the Middle East, including tensions involving Iran, can increase military spending, expand government deficits, disrupt energy markets, and push oil prices higher. Meanwhile, the government may need to issue even more debt. Investors may then demand higher yields to absorb the growing supply of U.S. treasuries. And when something finally begins to break, central banks can argue that they have no choice. Cut rates, inject liquidity, buy bonds, and potentially restart the money printing machine. That brings us back to gold. In the modern financial system, assets can broadly be divided into two categories. Printable assets include fiat currencies, government bonds, and financial claims that can expand through policy decisions. Unprintable assets include physical gold, silver, land, energy infrastructure, and scarce commodities. A dollar can be created, a bond can be issued, but physical gold cannot be printed by a central bank. History offers important examples. In 1998, the collapse of long-term capital management created serious financial stress. The Federal Reserve responded with rate cuts and liquidity support, while gold formed what became a major long-term floor. Then came the financial crisis of 2007 and 2008. As the system began breaking, policymakers again responded with extraordinary intervention and massive liquidity creation. Gold entered a powerful multi-year bull market. The circumstances were different, but the institutional response was familiar. When the financial system faces a major threat, policymakers tend to flood it with liquidity. That is the core of the $40 trillion trap. Debt is now so large that interest rates cannot rise indefinitely without creating enormous pressure. Yet rates cannot remain too low without risking inflation and further currency weakness. So the system may eventually return to the tool governments have repeatedly used throughout history: currency debasement. And if trillions of new dollars enter the financial system, while the real value of existing debt is gradually reduced through inflation, investors may increasingly search for assets that cannot be created at the push of a button. That does not mean gold rises in a straight line. Markets remain volatile, and liquidity shocks can temporarily pull down almost every asset. But the long-term argument is simple. Debt is too large. Interest costs are too sensitive. Yields cannot rise forever. And eventually, policymakers may once again turn to liquidity. For gold, that creates a powerful structural setup. Because when confidence in printable money begins to weaken, capital has historically looked for something that cannot be printed. And if the $40 trillion debt trap continues closing, there may ultimately be only one long-term direction for gold. Protect your future. Visit Aurauvault.com.